As per tradition, at the start of every new year, one major question starts circling the financial markets. How will the stock market perform this year? This year was no different except for the fact that everyone is predicting a recession will be striking the world pretty soon. There's one peculiar thing about stock markets. They always work contrary to popular sentiments. So that God is thinking about whether a recession will actually strike if everyone is talking about it. In the light of this, we decided to do some research of our own, and here are our 2 cents about it. Our first macro indicator is global liquidity. When global liquidity rises, asset values rise, credit expansion accelerates, and investors' risk appetite increases. Conversely, shortages can cause financial market disruptions and reduce investor risk appetite. This brings us to the question, how can we predict where future global liquidity patterns will go? To answer that question, we must go back in time. As you can see in the chart here, following the infamous housing financial crisis of 2007-8, central banks throughout the world have continued to flood financial markets with massive amounts of liquidity in order to promote growth. Now, according to fundamental textbook economics, any increase in money flow in the economy will be accompanied by an increase in inflation, but the reality was rather different. World liquidity increased as inflation remained constant until the 20th of February 2022, when the Russia-Ukraine war began. Commodity prices saw an unprecedented spike as a result of multiple sanctions imposed by the US on Russia, with crude oil soaring 38% in 5 days. This was well above what most central banks could bear, resulting in a shift from expansionary to contractionary policies, as central banks throughout the world began tightening the global liquidity by raising interest rates. Given the enormous amount of historical data available, we are going to use statistics from the US economy throughout this research. Let's start with a chart depicting the correlation between US equities and liquidity. The red line represents world central bank assets denominated in US dollars, while the white line represents the S&P 500 post the 2007-8 crash to the present. Both of them are following a similar pattern, indicating that a significant portion of the world's central bank money supply has been parked in equity markets since 2009. Now, if you see the highlighted part where both the liquidity and markets peaked, this is the exact point from where central banks around the world started raising their interest rates and unwinding their bloated balance sheets, which in turn led to fall in the equity markets. Next, we'll be taking up a comparison of yield on US inflation-protected bonds with the S&P 500. Treasury inflation-protected securities are government bonds that are designed to protect investors from inflation by adjusting their principal value in response to changes in the consumer price index. As the CPI rises, the principal value of TIPS increases, which leads to a corresponding increase in the interest payments that are made to the investors. TIPS has a negative correlation with equities because they are considered to be a safe haven asset. During times of economic uncertainty or market volatility, investors may seek out safe investments like TIPS, which are backed by the full faith and credit of the US government. This flight to safety can cause the prices of TIPS to rise while the prices of equities may fall. Looking at this chart, the black line running in the middle is the zero line. Hence, the sharpest rally witnessed by S&P 500 was post-March 2020, when US TIPS yield fell below 0%. The same was reversed dramatically with TIPS bottoming out post-February 2022, just when S&P 500 peaked and started its downfall. The Russia-Ukraine war, which caused a jump in commodity prices, fueling inflation and prompting central banks to begin raising interest rates, was one of the key causes for TIPS yield to rebound around 2022. This isn't the first time that interest rate hikes have been used to combat inflation, but there's definitely something unique about this current rate hike cycle. What is it? Looking at the velocity of rate hikes over the last 75 years, the current rate hike cycle is the sharpest in history, with a monthly average rate hike of 0.4%. The current macroeconomic crisis has often been compared to the 1970s. Even though the situation in 1970 was far worse than it is today, rate hikes that took 3 years in 1970 have now been executed in just 1 year. It is also important to note that except for the 2004 cycle, in every rate hike cycle, the financial markets have seen some correction owing to the tightening of global liquidity. So it is safe to assume that this rate hike cycle will continue until something major cracks globally. Another major effect of rate hikes is reduction in the ability of private sector banks to create new credit. This is measured by the global credit impulse, which is the net credit flow by banks upon GDP into 100. This statistic fell dramatically by the end of 2022 due to decline in overall credit flow. Every time there is a drop in credit impulse, there is a drop in equity valuations. There is no reason to believe that this will not happen again in the near future. Coming to the next chart, we have the total credit provided to private entities as a percentage of GDP, which is another leading indicator of the stock market. This statistic saw a dramatic fall post December 21, which was followed by a fall in S&P in 2022. All the above charts reinforce the same fundamental view that liquidity is the fuel of financial markets. Hence, as liquidity continues to shrink on back of central bank rate hikes, equities are going to face a tougher environment in the near future. Contrary to popular belief, the current inflationary pressures may not be temporary and is expected to persist in the near future. There are multiple forces at play that will keep the inflation elevated, namely deglobalization, decreased labor force, high commodity prices, China reopening, lack of capex in the fossil fuel industry, etc. Stay tuned for part 2 of this video, wherein we'll explore the effect of all these factors on our future inflation levels and what it means for the stock markets in the next 5 to 10 years.